Okay, hi everyone. This is going to be the first lecture on chapter 5. We're looking at gross income and exclusions. So here's the tax return, right? This is the 1040, the academic view of it. What are we examining here? Just this top item right here. Subsequent in the course, we'll learn about these other items, but right now we're kind of zooming in. We're doing the deep dive on this first line item, our gross income. Now, when we talk about our gross income, this is invoking Section 61, right, of the IRS code. And essentially, this provides that gross income is all income from whatever source derived. So, very broad, inclusive term here. We're looking at your worldwide income. Now, in this framework, right, we have to be aware that taxpayers are going to recognize income, put it on the tax return when they receive an economic benefit, they realize the income, and there's no tax provision that says, hey, you can exclude or defer this income. In other words, this is basically a more specific test to distinguish realization, i.e., economic income, from recognition, i.e., taxable income. So the first thing, right, the first problem here is that you have to have an economic benefit. You have to receive something of value. So normally, right, at your job, they're paying you cash, right? You're getting, items of value. Likewise, you sell property, you get cash, you get other things. You could have, rental income. You could receive interest. You could have dividends. There could be cancellation of debt. In other words, you're going from point A to point B from an economic standpoint, you have improved. Now, one thing to be aware of here is that borrowing money is not an economic benefit. The reason for this is you have an equal and offsetting liability to repay that borrowing. So yes, you got 10 grand from the bank, you borrowed it, but also yes, you have to repay that 10 grand. So you didn't really get an economic benefit there. It nets out to zero. So borrowing money, not going to be taxable income. All right, so income is realized, in short, when there's a measurable change in property rights. That is to say, assets or services are exchanged for cash, claims to cash, or other assets. Similar to what you would expect in financial accounting with the term realization. And this essentially lets us measure objectively, the amount that's going on. So if we look here, right, if we look at example 5.1, they're giving us some facts. They're saying, hey, a taxpayer purchases stock for $30 during the year. It looks like it fluctuates in value, and they don't sell the stock. How much income does the taxpayer realize? Well, in this case, they're going to have unrealized gains or losses. In other words, let me kind of draw and map this out for you. Hey, we buy some stock right here. It goes up in value, it goes down, right? Here we are at the end of the year. It's worth, maybe we bought it for 100 and it's worth 140. Okay. The idea with this is these are unrealized gains or losses. And in this way, because they're unrealized, we didn't sell the stock yet, right? We didn't get the proceeds from it. We don't report income from it. In other words, what would be wrong here is if you would say, hey, we have $40 of income, right? We went from 100 to 40 at the end of the year. Well, no, you don't. If you didn't sell it, if you keep holding on to it, that kind of appreciation and depreciation is unrealized, right? We don't meet the realization requirement. In short, right, the only time you pay tax when you sell stock, bonds, things like that, is when you sell the stock or bond. And as we'll see later on, it's going to be for basically your gain or loss. So it's going to be your amount realized minus your adjusted basis. Okay, next idea here, recognition principle. So this is essentially saying, hey, we're going to put it on the tax return. We have realized it. We're now going to recognize it. In other words, as long as there isn't a provision that says you must exclude this or you can defer it, the general rule is going to be what you realize is what you recognize. And as we looked before, right, you have $100 of realized income from your job, your wage job, you're going to recognize $100. In distinction, you have $100 of muni bond interest income. You've realized that, but you're going to recognize $0 of income because there's a provision that says, hey, you exclude muni bond interest. So the idea with this is, right, if you remember kind of the Kirby, right, we have like the vacuum where everything's getting sucked in. Normally, right, what you think of everyday income is cash, right? You get paid cash, you're going to pay tax on that. The idea with this is it's really anything that comes in, right? And what you're going to value it at is the fair market value of what you receive. So say, for example, right, we have Daniel and Mr. Miyagi, and say that Daniel was just he paints fences, right? If he was to paint Mr. Miyagi's fence, right, just normally by itself, he would charge $200, and if he was paid cash, he'd have to pay tax on that $200, right? It's realized and recognized. Daniel's trying to be sneaky, right? He says, hey, I don't want to involve any cash because that could make me pay tax. Instead, what I'm going to do is trade you, Mr. Miyagi. I will paint your fence if you, teach me karate. No cash is exchanged. We don't got to pay tax. That would be wrong, right? The idea with this is you have to include as part of your gross income the fair market value of what you receive. So in this case, right, Mr. Miyagi, what did he receive, right? We have Kirby, it's vacuuming it in. Okay, he got his fence painted, and that's worth the fair market value of $200. In distinction, right, if he gets karate lessons, Daniel, from his point of view, right, he has kind of like the funnel where it's all coming in. Let's just say that was worth $300. So the idea with this is you can't get out of paying tax if you're trying to swap or trade assets, right? So if we look here at 5.2, this example is just saying, hey, we have landlord and tenant, and landlord says, hey, tenant, if you babysit my kids, right, you don't have to pay rent this month. Well, the idea with that is, no cash was exchanged, but both of them have taxable income, the fair market value of what they received, right? So if you have Kirby here, right, he's kind of the puffball, not the greatest artist. Let me redraw Kirby. It isn't the best. Oh no, where did need to delete that and redraw him here. Right, we'll go with a green Kirby. More of a Pac-Man than Kirby. The idea with this is, right, you kind of have this funnel where everything's coming in, right? Typically it's cash, right? You're getting paid cash. But if someone pays you in services, right, like they paint your fence, they, babysit your kids, right? So maybe here's Daniel, he's painting the fence, right? There's his little paintbrush. He's painting the fence. Mr. Miyagi in this case, right, Kirby, he's going to value it at the fair market value of those services, right? And it also can be other property, right? So like say, Mr. Miyagi's like, hey, Daniel, I'll teach you karate. And Daniel says, I will give you my sword, right? My karate sword, right? There's the Ninja Turtle karate sword, right? And the idea with that is Mr. Miyagi, right, for him, he's going to measure that at the fair market value, right? It's not what Daniel paid for it. It's not Daniel's basis. Everything is always measured, right, this kind of cone here at the fair market value of what you receive, the services, the cash, the property. All right, next thing here, when we're talking about income is you have to be aware of the return of capital principle. So say you have a Charizard, right? You paid, $100 for this thing? So the idea is that's a disposition event. Anytime you have a disposition event, it's going to be your amount realized minus your adjusted basis, gives you your gain or loss. So your adjusted basis for purposes of, right now, kind of entry level in the class, it's basically what you paid for it. And let's say you sell it for $300, right? That's your amount realized, what you realized from this. So the difference, right, the $200, that is what you pay tax on, right? The gain. In other words, somebody might think, hey, I got $300 in cash, right? From this, I'm going to have $300 of income. That would be wrong, right? This thing right here, that's called a return of capital. In other words, you get your investment back, i.e. you only pay tax on the gain. All right, next thing here to be aware of is the idea of refunds. So generally, refunds are going to represent a return of capital and not be taxable, right? So the idea with this is, hey, I got a tax refund for $1,000. Do I have to pay tax on my tax refund? Well, no, it's just a return of capital. Getting a refund, right? It's not much different if you go into a store and something's $85 and you hand them a $100 bill, right? And they give you 15 bucks back. That's kind of the functional equivalent of a refund, right? You put $100 into the tax system when you really owed 85, right? That 15 bucks you get back, that's your money, right? And the idea with that is that's not going to be taxable. That's a return of capital. You're just getting your money back that you already paid tax on. In other words, it's your take-home pay, right? That $100 in your pocket, that may have cost you $150 at your job, right? To make, if you make 150, you only walk home with 100, right? After you pay tax. Just general, right? High level. So as a general rule, refunds are not going to be taxable. However, right, we have this modification to it where we have this tax benefit rule, right? The tax benefit rule says, hey, if you in year one, right, or an initial year, have a tax benefit, right, you take a deduction, and then in year two, you get refunded that deduction like a subsequent year, right? So maybe you take $1,000 expense in year one, you get the smiley face deduction, that's great. And then in year two, right, $250 of the expense was reimbursed. Maybe you go back to the store and they're like, okay, it's like partially broken, you can keep it, we'll give you 250 bucks. Or you get like a rebate in the mail, right? The idea with this is you now have a burden in year two. So in this case, a refund, right, getting 250 bucks back will be taxable. That's because you got a benefit in an earlier year. So if you think about it, this makes sense, right? Because what you could do is just take a bunch of expenses in year one, right? I'm going to go to Best Buy, I'll buy a computer, I'll buy a monitor, I'll buy a TV, right? Take the expenses here, and then in year two, just return all those items, right? It's kind of like leveraging these fake receipts and then returning it. The IRS doesn't like that. So general rule, refunds are not taxable. However, we have this idea of a tax benefit rule that says if you have a benefit in year one that you're like a deduction that you're refunded in year two, then you have to have income in year two. And that's to the extent of the benefit in year one. So where this gets tricky, right, is when you have the standard deduction and the itemized deduction. So let's compare two scenarios here, right? So let's look down here first. This is the easier of the two, right? Here's year one. Your, let's see what the facts are here. Your standard deduction was 12, and your itemized deductions were 15, okay? Now say in year two, right, you are refunded $2,000, right? So $2,000 refund. In this case, right, if you were to rewrite history, right, if we were to rewrite year one, right, so that'll be green here. So year one rewrite, right, our standard deduction would have been 12. Our itemized deduction would have been 13. right? So overall, what we did is, right, the bigger of the two, we took 15, but we should have taken 13. The difference between the two, right, is going to be taxable income. Okay, we got a $2,000 refund and $2,000 of income, right? So smiley face here, frowny face here. Okay, here is where it gets tricky, right? Let's look at this example up here, right? In year one, right, let's say the standard deduction was 12,100 and the itemized deductions were, no, we'll say 12,000 and 12,100, okay? All right, so we know, right, we're going to take the itemized deductions. They're $100 bigger. All right, now we go to year two, right, or a subsequent year. Here, let's say we're refunded one of the expenses that caused this itemized deduction of $150, right? That's our refund. So, hey, maybe we got a state tax refund or an itemized deduction, some type of property tax refund for $150. What we got to do is, right, rewrite history, right? We got to rewrite year one, just like we did down there, right? Year one, rewrite. So our standard deduction was 12,000. Our itemized deductions, right? If we didn't have that $150, it would have been what, 11,000. Let me just run this through here real quick. So it would be the 12,100 minus the 150, right? We're looking at 11,950. Not hard there, but just tired right now. So my math brain is kind of crunching the wrong way. But the idea here is, right, when we rewrite it, we would have taken the standard deduction. So the difference between the two, right, the 12,100 and the 12,000, right, we're going to do a $100 income in year two, right? So if you look at this, it's kind of confusing, right? Down here, we were refunded $2,000 and we have to report all $2,000 as income under the tax benefit rule. Here, we were refunded $150, but we only report $100 as income in year two. The reason for this, right? Why does this happen? It's because we have this standard deduction as the anchor, right? In this case, right here, right, we went up in year one, but our standard deduction, right, we only went down, right? We didn't go below the standard deduction. So the full amount, right, we're still above it. We're going to recognize the full income in year two. Here, what we did, right, in this example where we didn't get the whole thing, right, we went up, right, we had the itemized. When we went back down, right, we went below the standardized standard deduction, right? So this is going to basically serve as an anchor, right? So this guy right here explains why, even though we were refunded $150, we only include $100 in our tax return. In other words, we would have taken the standard deduction otherwise. It serves as like an anchor or placeholder. All right, let's talk about some other kind of mechanisms or items here. So these are kind of the rules that shape and craft the tax return. Right, so first thing here are our accounting methods. We have our accrual method and our cash method. Accrual generally says this: you recognize income when you earn it. You recognize expenses when you incur the expense. In distinction, cash method says you recognize income when you receive cash. You recognize expenses when you pay cash. So cash method's simpler, right? Cash in, income, cash out, expense. Most individual taxpayers are cash method taxpayers, but it's like slightly modified for a different rule. So generally individuals, your cash method. Next thing here is the constructive receipt doctrine, right? So this says, hey, cash method taxpayers, you are going to realize and recognize income when it's actually or constructively received, right? So if we look at 5.4 here, it says we have a cash method taxpayer, right? So the idea with this is we get cash, that's income. We pay cash, that's an expense, okay? So it looks like they got a check on 12/28, right? So we have year 1, year 2. So right near the end of the year, they get this check and they say, hey, I'm just going to sit on the check and cash it over here, right? Because if I wait to cash it, right, that's when I meet the rule. I can claim it on my year 2 tax return. Well, basically the IRS has caught on to this and they say, nope, can't do that. Under this constructive receipt doctrine, a judicial rule created through case law, if you have funds that are unconditionally available to you, you're aware of them, and there's no restrictions on the control, so all three, right, and each prong, can be violated, then you have to include the income. So in this case, right, with the check that you got, the funds were unconditionally available to you, right? There were no hoops you had to jump through. You just had to cash the check. You were aware of the check. And again, there weren't any headaches or restrictions on you cashing it. In this case, you can't just sit on it. You constructively have to include it on your year 1 tax return, even though you actually only got the cash in year 2. All right, next one here, claim of right, right? This is kind of the reverse of the tax benefit rule. What happens here is you have a burden in year 1, the income, but a benefit in year 2 of a deduction. So what's an example of this, right? Say that you work at a company and you get a year-end bonus of $5,000. That's great. And let's say that bonus is contingent upon the financial statements. Hey, the business made $1 million, I get $5,000. Right? So what you do is that bonus, you include it in year 1, right, as income. However, in year 2, you find out you're working for Enron, right? And that $1 million was all a big sham, right? You have to pay back, right, the income in year 2, that $5,000. Well, the idea with that is they're going to give you a deduction for that in the later year. So it's kind of the reverse, right? Frowny, smiley for claim of right, tax benefit, smiley, frowny. So you can think of it like emojis, right? You can think of it like burden, benefit, income, deduction, whatever works for you. All right, next item here is the next kind of topic or thing to be aware of when we're crafting and shaping the tax law is the assignment of income doctrine, right? So the idea with this is we have Richie Rich over here, and say we have his parents, right? That's great. Yeah, there they are. We'll give mom some hair there. And say that, the parents are like, we're in the 37% tax bracket, but our son, Richie, right, he's in the 10% tax bracket. So, hey, we're going to be sneaky, right? We're going to try to be like Daniel with painting the fence. We're going to try to be like the guy who's waiting to cash his paycheck. And what we're going to do is, right, we have income. We're going to try to just give it to our son and have him pay tax on it. The general rule here is you can't do this. In other words, if you earn income, you get money from your job, you pay tax on that income, right? You can't, and as you would see in example 5.5, you can't just take money that you earned from your job and put it in your kid's account and have them claim it. It doesn't work that way. Likewise, right, for like property, right? So say you have a rental property that generates, rent income. In the same way you can't take your paycheck, right? And so say you own the house, you can't take the rental income from that and just put it in your son's name. However, there's a workaround, right? The idea with this is to shift the income, right? You have to retitle it into kid's name, right? If you do that, right? If you have an underlying property, right? Rental property, stocks, bonds, you want to shift it to your kid, you got to shift ownership of that underlying asset to the kid to do it. So, general rule, earned income, you're never going to be able to shift from your job, can't give it to your kid. For more like passive income, like stocks, bond, rental, again, you can't just put the rental income and put it into kid's bank account. It doesn't work that way. If you want to assign it to kid, you have to give ownership of the underlying asset to kid. And this works good when the kid's like real young and they don't know any better. But the risk you run is, hey, once this kid is like 16, 17, 18, or even like an adult, right? If they become aware of this, they're owners of that property. So they could sell it. There's nothing you could do to stop them. Finally here, community property systems. You can look at this. This is, effective in a minority of states, like 9 states. Essentially, it says, hey, we're going to treat income that's earned by one spouse as equally earned by both spouses. So you can look at that. I'm not as concerned with, community property states. And with that, right, just kind of where we're landing in the lecture here, I'm going to end lecture 1.